chain management.
I can't get it at all. Kavya, what about you?
Good evening, sir. My name is Apr'24 and I got the Young Skill India certificate.
You are here for HRM, Human Resource Management, right?
Actually, I'm so sorry about this. The point is that can't hear you at all, and I don't understand what is wrong out here.
I will request you, sir, to check your network issue because your picture is also not very visible. So if you can adjust with another network also, that will be. Let's see if it works. No, Kedar, it's basically your bandwidth only, it will help. Because everybody is working in a different devices, so their bandwidth will be different. I don't know, some issue is there with the network or with the Zoom itself.
I think in that case, now I will. I'm sort of assuming that you can hear me properly. In case you want to say something, can you please type it in the chat box? I think that will be easier. Can see, please look at the chats. Can each of you please do this? Okay. Thank you, Kedar, Tanya, Kavya, for letting me know. So basically, can the other two of you also please just let me know what Vipin? Okay. Supply chain management, Deepti is BCom honors. Okay, fine. So we have one person from commerce, the rest of you, Prerna Singh, in French, and my specialization is HRD. Okay, Prerna, Deepti. Okay, in that case, now thank you so much for telling me that. Let's just continue with this. So basically, I teach, a very simplified finance course, for this for YSI, and the purpose is that people from a non-finance background, they get an idea about finance, and whether you're a working professional or you're a graduate or you're pursuing a graduation, it will at least help you to understand what this subject is all about, demystify it to some extent. And those of you who at some point of time might want to pursue this, in a, let's say, in a more in-depth fashion, you will begin to get an idea right at the start about what this is. So what I'll do immediately is I will share my screen, and then take you through the actual course. What exactly will I be covering in this course? So we can start with that, and then I'll take you through some of the different topics. So we essentially have 3 2-hour sessions. There is today and tomorrow, and then there is next Saturday. So I have the rather daunting task of giving you an exposure to this in the next 6 hours. And since most of you appear to be from non-finance backgrounds, I'll keep it as basic as possible. So one part of it is financial management. Now, in the financial management part, so essentially I have financial management, financial accounting, and financial planning. These are the 3 things which we'll be covering in this course. So as far as financial management is concerned, what will we be doing here? The corporate objective, like if a company is formed, what is its objective basically? The strategy and business model, we talk about that. Then capital structure. I mean, the word itself may not have too much of meaning for you right now, if you're not a finance person, but it will at least, I'll be able to tell you a little about it. Once you hear it, I'm sure you will understand. The cost of capital, this is finance after all. So ultimately, whatever you do, it is going to have an implication on cost and on profit. Dividend policy, working capital management. This is something which is absolutely essential if you begin to form a business tomorrow. If any of you decide to become an entrepreneur and you decide to set up your own business, something which you need to understand very, very well is working capital management. It's not as if you have to pass an exam in working capital management, but you have to be aware of the basic meaning of working capital. What is working capital? Because without understanding that, it is very possible that you will overextend yourself, or you will underfinance yourself. So it could create a huge problem for you going forward. Is there okay? Then strategic financing decisions. How do we decide on what to finance? How do it's it's also referred to as capital budgeting. And then there is a purely financial thing, valuation, which I will not be touching on valuation in these 3 sessions because it will be very intimidating. But otherwise, that is like core finance, valuing a company, valuing a share, valuing a debenture. Then we come to some basic concepts in finance, which are, let's say, I would say that somebody who is not in finance should have an idea about these things. Then the first one here, time value of money. The second is called the internal rate of return. And the third is called net present value. All 3 are, in a manner of speaking, let's say, interrelated with each other. But it is something which, if you're going to understand what finance is all about, you will have to appreciate things like this. What is the time value of money? Money in hand always has a higher value than money which is going to be received in the future. And as a concept, this may sound very, very simple, but then working out exactly what is the value in the future, what is the value today, for that, some simple calculations and an understanding is required. Hence the need for that, to understand this. Then this concept of present value, this affects the concept of internal rate of return. No matter, see, it doesn't matter whether you don't understand what I'm saying right now, if you don't. What is important is that these are things which we will be covering. And I can assure you that it's very possible for you to understand this and get a very clear understanding of what these things are. Once you understand it, it'll help you. Then there are certain fundamental principles in finance, stuff like the incremental concept, time perspective, opportunity cost. These are again things which, and there are many more. So this is like a snapshot of what we will be doing in the financial management section of this course. Then we have, yes, and in the fundamental principles, there's one more thing I've mentioned here, that is discounting. So once again, a typical finance word, but something which you'll understand pretty easily once we get down to it. Then the next is something which is not exactly my favorite, that is financial accounting. But unfortunately, see, accounting, no matter what you do with it, is less enjoyable. And unless you are someone who's wired that way, generally speaking, you will find that accounting is a little drab, monotonous stuff. But in the case of like, if you plan to, especially if you plan to become an entrepreneur, set up something for yourself, then understanding accounting, understanding a bit of some of these things, like financial statements and ratios, balance sheets, profit and loss accounts, cash flow statements, these are things which become necessary. You may not actually like it. So, but it is part of that whole territory, something which you have to, what shall I say? You have to live with it. There's thing in management, if you understand the hang of it, well, I think you might even enjoy it. But when you come to financial accounting, there is no guarantee on my side that you are going to enjoy this. But what I would suggest is that you try to just have the discipline to allow me to take you through the concept, so that at the end of it,
maybe some technical glitches there. So, sir may be joining at any point of time. Okay. So finally, Jyotsana, you are also able to join, huh? After lots of struggle. Today, it seems that the network is not working properly, right? But anyway, it's okay. So how many of you are comfortable with the financial management part? Even though it's a very important, Kedar Saab, how much comfortable you are with the financial management?
Not that much of, sir.
Yeah, your voice is not coming clearly. Hello?
Hello, I'm audible.
Yeah, yeah. Maybe, I don't know, somewhere your voice is not that clear.
Now?
Yeah, now it's better.
Acha, okay.
Mm-hmm.
Sir, financial management is hello.
I'm listening you. I'm listening you. Please go ahead.
Yes, sir. I'm not that much of good with financial management.
Mm-hmm. But don't worry. Sanjay Sahai sir he's from the industry basically. I told you, he's an ex-banker, right? So
Yes.
he
Yes.
understand the people's psychology, and he will try to teach you in a that way, like that layman language, which will help you to understand. So don't miss this opportunity. Only request you with you guys that if you are not able to understand, अगर कोई चीज कहीं नहीं समझ में आ रही, किसी को लैंग्वेज का प्रॉब्लम हो रहा है कि आप हिंदी में बोलें या इंग्लिश में बोलें, तो प्लीज रिक्वेस्ट. And I'm pretty sure कि sir is sir will accommodate according to your choice.
Yes, sir.
हाँ, तो आप लोग अपॉर्चुनिटी ना खोएं, और डोंट थिंक कि फाइनेंस कोई बहुत बड़ी चीज है. डेली आप ट्रांजैक्शन करते ही हो फाइनेंस पर. ओनली थिंक यू डोंट मैनेज और यू डोंट सी द ट्रांजैक्शन कि किधर गया किधर आया. तो आज एक मौका है आपके पास कि फाइनेंशियल मैनेजमेंट को जब आप समझोगे तो आपकी रियल लाइफ भी उससे इंपैक्ट होगी. आप ये देखोगे, suddenly you will start correlating everything with your daily routine life, and that will help you to become more good manager or a good financial management person, right? Yeah. Yes sir, please continue.
Can you hear me, anyone?
Yes, sir.
Yes, sir.
Okay, then I'll continue with the presentation. So this is what we had covered so far. We reached this. Financial accounting, balance sheets, profit and loss statements, cash statements, and the operating cycle of a business.
Yeah, sir.
Which in many respects is...
PPT is not visible. Yeah.
I can't hear you actually. Interpreting financial statements. So this is what we will be covering in the PPT is not visible. So, okay, I'll try again. Is it visible now?
Yes, sir.
Okay. And in that case, let's continue with this. So, and then we come to financial planning. Now, this financial planning segment is more about personal finance. So, if we have a certain sum of money, how do we actually invest it? What, let's say, is the requirement for insurance, for mutual funds, for equities? What are the risks involved? Understanding these things, I think that is the purpose of this financial planning section. To that extent, the financial planning as such, let me tell you, will be the easiest of these three. Of all these three, it will be the easiest, and it is something which will have relevance for all of you. This is about your own personal, let's say, your ability to take your money, invest it wisely, to borrow wisely, to protect yourself wisely with insurance. That is the purpose of this section. So by the time you get through this entire course, you should have a working idea about these things. And they should be able to empower you more, whether you're a student or whether you have you're working on it, whichever is the case. So with that, since the whole problem is that since I can't hear you, there's this constant echoing coming. This is going to be a one-way thing for today. I can't figure out how to fix the problem. There's this constant thing happening at the back, and whenever anyone of you speaks, it just an echo. So when we talk about
Sir, if you
the
have any
importance
other,
of finance,
if you have any other network, please try with that, because your voice is not coming clearly, and PPT is also not changing.
मेरी आवाज आ रही है अभी साफ? Hello, Neeraj ji, can you hear me?
Yeah. We are able to hear you, sir. Please share your PPT.
Connection or I can see all of you now, but Kedar, can you hear me properly?
Yes, sir.
You can hear me? Okay.
Yes, sir.
Then I'm trying again. Okay, so coming to this, the importance of finance. So basically, the point I'm trying to make is, irrespective of what career you choose, irrespective of what you do, finance is going to affect your life in one way or the other. If you're an employee of a company, you have to know how financially healthy your company is because your job depends on it. And if you can, basically understand a bit of the section on financial accounting, where we try to understand balance sheets and profit loss accounts and those things, it will help you to analyze your own company if you get access to their financial statements and understand what your company is doing. Then, if you are an entrepreneur or going to become an entrepreneur sometime in your life, this is understanding finance is an absolute must. See, the first thing in any entrepreneurship venture is the idea that you have. Exactly what need in the market do you choose to fulfill? Is there a demand for the product that you want to sell and those things? The marketing aspect, some of you are going to be getting into the marketing part, that is all fine. But all these things will fade into insignificance if you cannot get the financial numbers correct. Ultimately, it all depends on that. So you can have an excellent rocking idea, a business idea, but it's not going to do well if you mess up on the finances. And as a banker, I've spent a long time, almost 30 years of my life as a banker. And I can assure you that I've seen any number of people who have managed to bungle the entire project mainly because of their lack of knowledge about finance. Now, the next is if as an investor. So once again, understanding the risks involved in when you invest in a particular type of company, and where you should invest if you want to have a relative degree of safety. Once again, that needs an understanding of finance. And finally, as a lender, you'll have to imagine yourself in the shoes of a lender, and then try to see just how important finance is for you. So it doesn't really matter where you are on this entire scale. This financial part is something which is going to really be very, very critical for you.
Yeah, I hope everybody is comfortable with the English. अगर किसी को हिंदी में भी बात करनी है तो आप सर से रिक्वेस्ट कर सकते हो, so that he can mix and match both the things. Please बोले आप.
Shall I continue, Neeraj ji?
हाँ sir, please.
So basic point is, this is a subject about which you should have a basic understanding, and that is what we want to do in this course. Okay, then if I were to define finance, coming to a definition of what it is, basically you're looking at finance is defined as the management of money, including borrowing, lending, budgeting, saving, investing, and forecasting. That just about covers all aspects. Borrowing and lending, two sides of the same coin. Somebody lends, somebody borrows. Budgeting, equally important. The moment you get into any sort of planning for the future, this is going to come. Saving, whether it's a company, whether it's your personal finance, this is something which saving and investing both are equally important. And then forecasting, very important, whether you're doing it as an equity investor, equally important if you're trying to forecast developments in the market so that you can position your company correctly. All these things, finance will have a critical role to play. Now, what I thought was, let's try to think about this definition from the point of view of a startup. So you can look at, finance from many vantage points, but I think it sort of gives you a very good idea if you sort of think of a startup and, of an entrepreneur who's starting a business. And in that case, how exactly finance, plays into his game. So what are the resources needed to start the business and what will they cost? Let's start here. So one way of, doing this whole thing is, how much money do I actually need to set up my business? Right now, I'm assuming you already have an idea. You have a business idea. You understand the particular niche in the market that you're going to be serving. You know exactly what you're going to produce, what you're going to sell, whether it's a service, whether it's something physical goods. That doesn't matter. Some things will remain common. You'll need an office, you need furniture, you need computers, you need equipment, you'll need maybe some software, things like that. So what do these things cost? Once you get that cost part clear, your next issue is, where are you going to get these funds? See, no entrepreneur is able to run a big business only on the basis of his own funds. That never happens. You can start, even a mom and pop store ultimately requires some bank finance. If it's something bigger, you will be required to come up with some capital of your own, what's sometimes referred to as seed capital. But that seed is not going to sprout into a tree unless you water it with more capital. And that capital is always borrowed. It's either borrowed, or in the case of a company, other people join you. They become shareholders. And they basically decide to trust you, and they give you money. You give them shares. And then as your company grows, they get dividends and they make money along with you. So the source of funds is a very, very critical thing. Then if you decide to borrow, where do you borrow the funds? Now, normally when we think of borrowing at a personal level, the only thing that occurs to us is the bank. You go to the bank, you borrow there. There are so many, or if it's not a bank, you could have, so many of these online lending, facilities are available where you can go and borrow money. But if you are actually going to invest big time in a business, you'll have to understand that there are other ways of borrowing also. People can actually lend money to you if you give them bonds. In your own company, which is like a debt instrument. It's like you're promising to return the money in a certain number of years. And between the time you receive the money and the time you actually return it, you will be paying a certain amount of interest to them. So instead of, in a bank, what happens is you go to the bank, you need, let's say, 5 crores of rupees. You try to convince the bank to give you the entire money. In the case of an issue of bonds, you're going to put it out you will make a public issue of it, and you will ask members of the public to buy your bonds. So that is also a way of borrowing. Once you get the money, you go about your business, and then as you earn, you repay. So that's the next part. Then let's look at this in a little bit more detail. So you're going to start a business. This is, let's say, just a sketch of a factory that we have. Factory, buildings, office. You need people to run your business. You're going to need office, tools, cars, equipment, whatever. These are let's say, some of the basic stuff which you'll be requiring. This is the, essential infrastructure. The first part, this factory, buildings, office, these are referred to as capital assets. So essentially, these are long-term assets. These are going to be there for as long as your business is around. It's a big investment. It's generally a one-time investment. You will be, over a period of time, you will be adding to this. You'll be renovating it. You'll be modernizing the whole structure. That's all there. But the fundamental framework is going to remain the same. Now, when you finance this, you will be using what are referred to as long-term funds. Now, the concept of a long-term fund and a short-term fund is essentially this, that in a long-term fund, it means you have access to the funds for a long period of time. For example, if you borrow money from a bank, the bank expects you to repay that money in how many years? Let's say they say you repay it in 7 or 8 years. Then you know that this money which I get from the bank, I will have to return this in 7 years. And so is this enough for you right now? If you use that money to set these things up, it's a good bet, but you will have to make sure that you repay that loan within those 7 years. This is an example of a long-term fund. Another example of a long-term fund is if people buy shares in your business, you give them shares. The best part of a share is that the company never pays back the money to its shareholder. See, this, I don't know whether this sounds counterintuitive to you. If you buy a share in any company, let's say tomorrow you decide to go in for trading and you go to the stock market and you buy, let's say, 100 shares in HCL. You get the shares. Can you sell it back to HCL? Is there any way of selling it back to HCL? You can't. The only way you can offload your investment is to sell it in the market. You'll have to go back to the stock market, where you will obviously find other people who are willing to buy that share from you, and you will give it to them. But look at it from the point of view of the company. The company itself knows that this shareholder, the money that the stock which somebody has bought from it, the share which someone has bought from it, that is going to stay with the company till the company actually exists. Till that last day when the company closes down, that capital will remain with the company. Now, you can't get more long-term than that. No? So equity that way is considered to be the best source of funds. That is one part. Now, you think of this, human resources. You'll be employing people. So when you employ people, you have to pay them salaries. Now, these salaries which you pay them, see, you pay, it's not like a one-time investment. You have to keep paying. You'll be paying them every month. So this is like a recurring expense, something which is going to happen. Those guys are going to work for you. They'll give you a certain amount of service. In return, you will pay them. Now, this will happen every month. Therefore, this has to be financed from your working capital. That's the basic idea out here. Next, you think of this. All the office that you maintain, all the consumable items, let's say tools will require to be maintained, machines will require to be maintained, there'll be spare parts, your cars will require fuel to run, they have to be maintained. All these things are consumables. These consumables, these expenses, you are going to be incurring on a recurring basis. It's going to happen every month. And this again is part of your working capital, this part. Now, similarly, the factory that you have, in this factory, you're going to be using raw materials. Whatever you're making, essentially what happens in a factory, you add value to some raw material that you get from somewhere. you add value to it, you convert the raw material into a finished product, and at the end of it, you sell it. Now, when you buy raw material, there is a certain amount of time it will take to convert the raw material into finished goods. And then it will take a certain amount of time for you to sell those goods. Once that cycle is complete, you will be buying the raw material again. And then the whole process starts all over again. That is generally referred to as the operating cycle. Now, this particular thing, this is again financed from your working capital, because this is again a recurring expenditure. You buy raw material, you pay people to work in the factory, you sort of use the machines. Using the machines itself there is a cost to that. You use power, then you have your data lines coming in. All sorts of things are there which you'll be using on a day-to-day basis. And this will come from your working capital. And then at the end of it all, you will get your finished product, your business will run. Now, the long-term funds that you have, the sources of these long-term funds are going to be from either your shareholders, that is referred to as equity, or it's going to be from either your banker, debt, or from individuals who have bought bonds in your company, which those guys are bondholders. That is also another form of debt. Then the working capital that you have, this you get a certain amount of short-term credit from your suppliers. People who supply you raw materials, they give you a certain amount of time, let's say a month, 40 days, 45 days to pay them back. So that opens up a sort of a window of short-term credit for you. Apart from that, you will also have to have a certain amount of funds of your own always available for ensuring that your working capital needs are always met. So that's like an overview of the financial aspect of starting a business. Now, if your idea is good, if there is a demand for what you have sufficient capital, you do your marketing properly, then at the end of the day, you will make sales. And the sales that you make will come back to add to your working capital and will allow you to start another cycle of business. That's the way the business thing works. Now, let's talk about where the entrepreneur gets the funds. So let's just try to look at it like this. Let's say he has, this is a freak scenario. All the funds are brought in by the promoter himself. Okay? Total funds by promoter. Now, if this is the case, then we would say that this particular firm has no debt. It is entirely financed by equity. Let's say it's a company. All the shareholders here, everybody has basically, they've got shares in the company. And there is no outsider involved. Everything is basically financed by the promoter. All the shares are bought by the promoter himself. Like think of somebody unbelievably rich. He decides to set up a company. And then he decides, I don't need anybody's help. I'll just finance it myself. So it's a family business. They bring money. They are the promoters. They do it. So this is one case. This circle represents the finance available. It is entirely self-funded. So we say it's 100% equity. Then you get some other rich individuals to buy shares in your company. And this red section here, you basically sell it to them. Imagine this green thing is this is the pie here. From this, you take out this and you sell it to some shareholders. Obviously, you'll be selling it to them for a higher cost than you actually incurred. Even in this case, There is no debt. They are shareholders. See, please remember the essential difference between debt and equity is, in debt, it has to be repaid. In the case of equity, you don't repay. That money remains with you. If somebody who has a share in your company wants to quit, the only option the person has is to basically sell it to someone else. But as a company, you are not expected to return the money to him. So this is the second scenario. Once again, 100% equity, in which, as per this particular diagram that I'm showing you, most of it, 3/4 of it, are with the promoters, and this red chunk here is with the other shareholders. Now, if you think this is unlikely, you'll have to think again. Take some of the biggest companies in the world, Apple, for example. Absolutely debt-free, no debt at all. Their capital structure, this is an example of capital structure, would look something like this. So you would have guessed by now, this is what capital structure is all about. Within that, that if you call that framework of funds that you have as the structure, within that structure, what is the component of equity? What is the component of debt? So have you borrowed money, or is it entirely financed by shareholders? Now here, take the other scenario. This is the most common scenario. 51% are in the hands of, let's say, the shareholders, the promoter shareholders. 19% is in the hands of the other shareholders, and 31% is loans. Now, you've borrowed from the bank. I'm using one word, loans. Basically, this represents any form of borrowing that you may have had. Now, it'll look like this. Owner's equity, shareholders' equity. Now, the proportion of equity is 51 plus 19. That should be 70. There's some decimal involved. And this 31% here. Okay? So this is one, and this is another one. These two, there is no debt. Here we have debt. And all these pie charts are examples of capital structure. The whole purpose of making this slide was to explain to you that whenever you hear the word capital structure, it should immediately occur to you that what we are basically talking about is the proportion of equity and the proportion of debt. And debt, remember, a bank borrowing is debt. Selling bonds to a bondholder, that is also debt. What is the commonality between both? In both cases, the money has to be paid back. In the case of equity, money doesn't have to be paid back. All that you're giving is dividends. So every time you make a profit, a certain share of the profit is given to your shareholder. In the case of debt, what do you pay? You pay interest. Every time you borrow money from a bank, they tell you this is our interest rate, and you pay that amount to them at regular intervals. It could be monthly, it could be quarterly. That's a different thing. So the capital structure basically tells you where the company is getting its funds from. So whenever you come across a company and we try to figure out, the first thing we want to know is, where does it get its funds from? We look at its capital structure. So you may find, for example, just to make it slightly lighter, we've been reading about electoral bonds, correct? All of you, I'm sure, would have been taking some interest in this. Almost all our political parties have been receiving electoral bonds. Now, the electoral bonds, in many cases, have been bought by companies. But what we really want to know is, the company which bought the electoral bond, who actually owns that company? That is the thing which is interesting for us. All the newspaper articles, everything that you've been hearing on TV, it's all about that. And who owns the company? The guys who own the equity. So essentially, when we talk about equity, we are talking about the owners of the company. And like I said, the owner of the company could be just the promoters themselves, or they could be a combination of the promoters and other shareholders. Third scenario is owner is all these three. But remember, once the loans are paid, this entire thing will once again revert to the equity guys. So the owners of a company are those who have the largest share of equity. Now, the largest share of equity need not be 51%. It just has to be more than the other shareholders. You will find that if you look at the shareholdings of some of the big companies, you will find that the big industrial group that we know, they don't have 51%. They may just be having 30%. But nobody else has a block of 30% shares. Everybody else may be just like, for example, smaller shareholders would not even be having 1%. Even the big institutions would not be having more than 5%. But the group of promoters who own the company, they could be having 30%. And on the basis of that 30% equity, they would actually be controlling the entire company. That is the case for all companies over the world. Remember this system which we got, the concept of a limited company. Incidentally, when we say limited company, have you ever thought about the significance of the word limited? So essentially, when we say limited, it means that your loss or your liability is limited to the number of shares you have in the company. You may be an owner of the company, let's say even the promoter. What is the most that the promoter can lose? The promoter cannot lose more than the equity shares that he or she has in the company. So the liability is limited. This was the whole concept. When this concept came up in England, way back in the 17th century, this was the idea that when people invest somewhere, take a risk. See, whenever a company is formed for a business venture, there will always be a risk. Now, when people do this, at that point of time, you have to give them some comfort. Na? Otherwise, nobody will want to invest. They will say that it's a risky thing. Think of, let's take a historical example. Take the East India Company. Now, right now, we're not looking at whether it was a good company, bad company, nothing like that. We're just looking at the business aspect. There are a bunch of people in England. They feel that they can make money by investing in distant countries in the East, which they have never even seen. They feel that if we can take ships, go to these countries, collect, let's say, spices, bring them back, sell it, we'll make a whopping profit. And at the same time, there's a huge risk involved. The ships may sink at sea. When you get there, maybe you won't be able to make a good deal. You won't be able to get those spices at a reasonable price. If you get the spices, load them onto your ships, coming back, the ships may sink again. The technology wasn't that great. If you manage to get the spices back, will you find buyers for these things? These are new things. So remember Europe before, back in the day when each continent was more or less contained within its own boundaries. There was no communication, no knowledge about each other. So you're selling an unknown commodity. When you take risks of this sort, how can we encourage people to take risks, to form companies, because the moment companies are formed, and they begin to do well, they generate revenue for the government. They give employment to people. So how do you enable people to do these things? The solution was limited liability. They said, okay, fine, invest only that amount which you can afford to lose. Don't invest stuff. Don't over leverage yourself. Don't overextend yourself. If you do that, tomorrow if you lose, it's going to be a problem for you. So what you do is invest up to the extent you can bear the loss. And for that, this concept of a limited company was created. And within limited company, the concept of capital structure works like this. I'm sorry, since I can't hear what you guys are saying, I just hope that so far, whatever I've said is more or less clear to all of you. Okay. So next thing, concept here, owner's equity plus shareholders' equity is equal to the shareholders' capital. Okay. And to this, we will see a third component of capital. We'll get to that. Now, think of this from a cost point of view. So let's say that there's an entrepreneur, he wants to start a business, and it's very modestly priced at rupees 10 lakhs. Now, his own funds are 5 lakhs. He gets an investor partner who decides to put in 3 lakhs. So the share of the entrepreneur is 62.5%. This investor, he's got 37.5%. Okay. Equity is 8 lakhs. Same thing, the capital structure that we saw in the last page, it'll work like this now. Then he borrows 2 lakhs from a bank. So his debt is 2 lakhs. So the capital structure is what? Equity 8, debt 2. Within equity, own funds 5, outside funds 3. But this entire 5 plus 3 is money that will remain with the business as long as the business exists, because these guys are shareholders. This money from the bank, this 2 lakhs, this has to be returned. If it is not returned, the bank is going to bring an action against the company, which will be bad for the company in all ways. So equity shareholders are the owners of the business. If the business fails, they lose their money. If it succeeds, they get dividends and bonus shares. So bonus shares are shares which are given to you by a grateful company management for investing in their company. And those shares are given to you free of cost. So if the company really begins to do well and you remain invested in the company, your own shareholdings will increase without you spending any extra money because of the allotment of bonus shares. The creditor here expects to get his repayment with interest. He is not an owner. He has a claim to the amount given as a loan. So this is the basic thing that you need to remember out here. Now, can the capital structure of the company change? Let's say we just saw that we have 5 plus 3 plus 2 in the last slide. Now, can this change? How can it change? So it will change if you introduce either more equity or more loans into the company. If you want to expand the company and you need more funds, basically what you're going to need is, just give me a moment, guys. I'll just switch on the lights here. So it will change if you bring in more equity or you borrow more. So some companies prefer not to borrow and they sort of keep investing their own funds. some don't. So sources of equity. First is fresh issue of shares. So you guys all have heard of an IPO. All of you, I'm sure, have heard of the word IPO by a company. Anybody who hasn't? Can some of you put your hands up if you haven't heard of an IPO? So I'm assuming that everyone has heard of an IPO. Full form of an IPO is initial public offering. So basically, the offering is an offering of shares. Public, because it's being offered to anybody who wants to invest. And initial, because it is the first time the company is floating its shares in the market, or the first time the company is requesting money from the public. So that first time brings in equity. Now, if the company wants more equity, it comes out with what is known as an FPO, a follow-on public offering. That's another request to the public to buy more shares in the company. But by this time, between the IPO and the FPO, the track record of the company is available for everyone to see. So everyone can have a look at it and basically know just how well this company is doing, what are the goods it produces, what sort of a market presence does it have, how does it actually go about its business. You know everything now. The second source of equity, this may not be very intuitive, but try to look at it logically. The company is owned by the shareholders. Therefore, the profit earned by the company, which remains within the company. Let's say you earn 100 rupees of profits, and in that 100 rupees, you decide to distribute 50 as dividends to your shareholders and keep 50 rupees within the company. You can do this now. You want to expand the company. So this 50 rupees which remain within the company, this 50 rupees is an internal source of capital. Because ultimately, this will increase the value of the shares which the shareholders have. Let's say the shareholder bought shares, it was 100 rupees. And at that point of time, the company was just starting. Tomorrow, the company makes a profit of 1 crore. And 50 lakhs are retained within the company. Now, these guys who had those initial investment in the company, this 50 lakhs belongs to them. So you just find out proportionately what is the extent of 50 lakhs in each share, and the share value has gone up by that much. So the profit earned by the company, which is not given out as dividend, that profit is an internal source of capital because that money is available to the company to reinvest in the company. If it wants to invest, this money is there in the bank. It can take that money and it can invest. So that's one source of equity. I've written this down here. When a company earns profits, it has the option of paying out a proportion of the profits as dividend to its shareholders. The rest is kept or retained within the company for purchase of assets, etc., for expanding the operations of the company. Now, this option which I've written is a serious thing. See, when a bank gives a loan, you have to pay interest. But when you take money from a shareholder, somebody invests in your company, you don't have to pay him a dividend. There is no legal requirement for you to pay. You will be doing nothing wrong if you don't pay. You may become unpopular. You may have tomatoes thrown at you at the annual general body meeting. That's a different thing. But you will still be legally correct. If you take the view, and if this is supported by a majority of the shareholders, you can actually say that, no, this year we will not pay any dividend. We are going to take this money and we are going to put the entire money back into the business, expand it. Maybe I'm going to buy more machines because I see that my product is doing very well. The market can, sort of absorb much more of my product. So what if I want to expand capacity, I need to buy more machines. Where do I get the money for this machine? So you say the profits are already there. I'll take part of these profits and I'm going to buy a machine. I want to buy, let's say, some particular intellectual property, stuff which new formulas. I'm a pharmaceutical company. I want to buy formulas for my new medicines. Big money for that. Where am I going to get it? Simple way, use your profits to do it. So a company which is actually earning a lot, that sort of company is in a position to generate capital from its profits itself. What happens if the company goes into loss? Then in that case, obviously, the capital is not going to increase. The capital will decrease because the loss part of it comes out of capital. We'll not get into the accounting part here, but so now let's look at the dividend part. Total profits of the company is this full circle. So the board of directors may take the view, we retain 50% within the company and we pay out to the shareholder 50%. So it's known as a dividend payout. Payout in the sense the funds are flowing out of the company. That's why it's called a payout. This decision, 50-50 or 25-75 or 75-25, this decision, again, I'm repeating this, is entirely up to the board of directors of the company. As long as they have the support of the majority of the shareholders, they can actually take any decision that they want. The example is like this. A company makes a profit of rupees 100 crores. It decides to retain 50 crores for increasing the assets of the company. The amount of 50 crores will be added to the shareholders' equity of the company. Whatever the equity was in the beginning, that will increase by this amount. So we can look at the actual capital structure of different companies operating in India. I'll show it to you there. Where does this appear in the balance sheet of a company? See, everything we said here will be found in all the equity things we spoke about, the debt that we spoke about. Where is this available? Where can we see this? So we can see this in the balance sheet. Okay, so next I'll show you a balance sheet. So this is a balance sheet of HCL Technologies. I've taken 3 years at random here, March 19, 20, and 21. So start with 19. So what does it say out here? Shareholders' funds. Within shareholders' funds, what have they done? They say equity share capital is 271 crores in March 19. That means 31st March 2019, the equity share capital of HCL was 271. Please keep your eyes on this figure. Don't look here. Total share capital is 271. First part done. This is your equity component. Reserves and surplus is 30,168 crores. So this reserves and surplus is the profit that the company has earned ever since it was created. From the time HCL began business, many tens of years ago, from that time till today, they have earned this amount as profit, which is retained within the business. Remember, we said that it is up to the board of directors to decide whether they want to keep the money inside or they want to use it for invest or they want to pay it out to their shareholders. So this is the amount of money which they decided to retain. It's within the business. In the balance sheet, it's going to appear in an item called total reserves and surplus. So this amount is there with the company. Everything that HCL has done, it is essentially from these funds. You see, look at the difference. The amount which they brought into the company by March 19 was just 271 crores. What I'm saying just is, compare it with this figure, 30,168 crores, which is almost 12 times the figure here. So this entire amount, this is their internal capital. This is what they have earned. Now, if you look at total shareholders' funds, what are we doing? we are adding total share capital with the total reserves and surplus. So if you add 271 to 30,168, you will end up with this figure, 30,439. This is the total amount of equity which the company today has. The equity itself being divided into the initial investment and the earned profits. Now, if you look below, long-term borrowings are ridiculously low, 32 crores. In other words, HCL has hardly, you can hardly call this, it's not significant. 32 crores, anytime they want, they can take this and adjust it. There would be some good reason why they have this on their books, but essentially it is almost a debt-free company. So it's running from funds that were invested in it and that were generated by it through profits. Now the profits which it earns will reflect here. Now let's look at this, March 20. This 271 has become 543. It's like exactly double. Basically what that means is that they have brought in fresh money. Fresh equity has been pumped into this. This could be by the promoters, it could be by other equity shareholders, but essentially it is fresh money being pumped into the system here. The reserves and surplus, if you notice, it was 30,168 in March 19. On 31st March 2020, it has increased to 36,753. This almost 6,500 crore increase, where did it come from? This is the profits that the company made in that 1 year. The profit that it made and that it decided not to give as dividends. That is the amount which is being added to the reserves. So every year, the part of the profits which the company decides to retain with itself will keep getting added to this reserves and surplus. So look at the third year, March 21. This 36 has increased by almost 7,000 crores to 43,000. Where did the 7,000 crores come from? Once again, these are the earnings of HCL. And look at the interesting thing. The actual amount of equity shareholders, amount which they actually invested, is just 271 crores. But the profits that they get are 7,000, 6,500 crores every year. And that is why this figure is so large. Now, there will be years when they will not get so much profit. But now that the base is there, this is something which will always help them to be financially steady. Now, if you look at this, long-term borrowings, now the logic of increasing borrowings, the only thing I can think of is that some cheap loans were available to them. For some reason they fell, because ultimately it's all about cost. Now, say if you take equity, the equity shareholder, whenever somebody invests in a share, he expects to get a fairly decent return. So that return which he expects and which the company is expected to deliver is the cost to the company. So in a manner of speaking, the dividend that it pays is the cost. Because that amount no longer remains with the company, it doesn't remain with the owners. That amount actually goes to the shareholders. Some of it, of course, will go to the owners because they are also shareholders. But some of it will go to other shareholders, guys who are not owners. Okay, then this gives you a basic idea of the balance sheet liability side. These are called liabilities. Why are they called liabilities? Because these have to be paid back if the company closes. If the company tomorrow shuts down, these equity share capital guys, all the shareholders here, they will expect to get this money back. How will they get the money back? The company will be expected to sell its assets or sell itself to some other company and return the money to these guys. So anything which has to be paid back and which is a source of funds is a liability. Anything that you create out of this, the factory buildings that you put up, the office buildings that you have, all the computers and all the entire network that you create, physical stuff, all that is your assets. Then you'll have intangible assets, all the software that you have, all the intellectual property that you have, all that will be the intangible side. They don't have a physical presence, but they are just as valuable to you. So what I've said here, I've more or less written for you out here. I'll be sharing these presentations with you, so you will have a good idea. So note that in March 19, equity share capital was 271 crores. By 2020, it had increased to 543. We can assume that shares were issued and shareholders contributed to the capital. Similarly, the story of the reserves, that's here. And the story of debt, it's here. Okay? So this is one example. Now, why do you think the debt is so small? Think about it a little. Basically, because in the case of a software company which is giving services, you don't need so much money for capital investment. Remember, we said capital assets are those things, the factory buildings and the machines and things like that. In the case of software companies like HCL or Infosys or TCS, the basic thing which they require, the assets which they require, are human assets. They need good people. They don't need to invest in machines and all. So essentially, they just have to hire people. A steel company or a car company would have huge investments in physical, infrastructure, like machines and buildings and assembly lines and things like that. But companies which deal in software, all your internet companies, these guys, they don't need to invest a lot in the physical side of things. So their requirement is less for debt. It's only when you need to invest a lot of money into physical assets that you have to take debt. So that's the reason there. So capital structure and cost of capital. Now remember, the capital structure that you have, the equity and debt, which we've talked about, the proportion of equity and the proportion of debt that you have will have an impact on the cost to the company of this capital. Okay, so these are like repetitions of what we've done. Equity and debt are the only two ways of obtaining capital for the company. Remember this, there's no other way. The board of each company decides on the proportion of equity and debt. For example, 80-20 or 50-50, whatever you want. Both equity and debt have a cost. Equity capital is not free. See, you may have the option not to pay dividends, but you cannot get away with that year after year. Normally, when you don't pay dividends in 1 year, you tell your shareholders that, look, this year we're not paying. We're taking that money and buying assets and investing the entire thing in the company. But the purpose of that is that next year, we give you much, much more by way of dividends. Because if we invest in our company, we create a big base, we're going to get more profits. So ultimately, you will have to pay. That's one. And shareholders generally will want a better return than the banker. The banker is secure because has mortgaged some of your company's assets. If you don't pay, it will sell those assets, get back its money. But in the case of a shareholder, he is giving it to you on trust. He is giving, you're buying, whenever you buy a share in a company, you don't have any security. You are essentially trusting the company to do well and to give you good dividends. So you expect more. Your risk is higher. If the company folds tomorrow, if the company crashes, you lose all your money. I remember I had a investment in Kingfisher Airlines. Small investment, 10,000 rupees. But when the company went, that money went. There was no way I could get it back. So the risk is huge for a shareholder. And the basic principle in finance is that a guy who takes higher risk looks for a higher reward, looks for a higher return. Therefore, a shareholder, since he is running a higher risk than a debt holder, like a bond holder or a bank which is lending to the company, the shareholder expects more than the bank. So essentially, shareholding is a costlier way of financing. But it is the most stable way of funding your company because, like we said before, whenever you take equity, you never have to return the equity. They cannot demand that money back. So that gives your own funding a huge amount of stability. Okay, so that's one part. Now, so suppose you take a loan of 1 crore. It's taken from a banker. This is debt. The banker wants 12% interest. So cost of debt is 12%. So we're talking about cost of capital, cost of debt is 12%. Now suppose 200 crores is raised through equity shares. What is the return the shareholder expects? Like I said, he's going to expect more than that 12% which the banker asked for because he's taking a higher risk. Think of it like this. The banker has, let's say, mortgage of assets. Tomorrow the company collapses. What is the banker going to do? He's going to go and sell those assets, get his money back. What can the shareholder do? He can't do anything. He'll have to wait till each of the debt holders have been paid. Whatever is left, from that, he will get whatever he can get. He may have invested 100 crores, 50 crores. Maybe he'll get back only 10. He cannot claim the other 90. Whatever he gets, he gets. So remember, the shareholder has a higher risk. Therefore, he expects a higher return. This is the point I'm making out here. Okay, and then for a shareholder, normally a reasonable return, looking at trends in the market, is say somewhere between 15 and 20%. You get more, you might get less also. But this is what you consider a good return. Okay. Now, we also said this, what happens if the company is not actually bound by law to give dividends? So what happens if it doesn't give dividends? They can't take legal action. But what will happen is people will gradually begin to sell their shares and move out of the company because they'll realize that it's no point investing here. It doesn't give dividends. Maybe it's misusing the money. As they begin to move out and as they begin to sell the shares of the company, the share price will begin to drop. And every time the share price drops, the total value of the company also comes down. And who loses the most? The promoters of the company. Why? Because they have the largest amount of shares in the company. This is the basic point. So ultimately, even though there is no legal requirement to pay those dividends, all companies will want to pay dividends and pay them regularly. And whenever they don't pay dividends, they will come up with a very convincing argument to say why they are not paying dividends. Okay. Now, let's just look at cost. So we'll take two companies, A and B. Let's say they have identical profiles, similar business, company A, company B. So company A, the capital structure is something like this. It has shareholders' equity. Let's say the cost of this is, remember we said the cost of equity will range between 15 to 20%. Just, it could be more, it could be less. But for this example, I said, let's take this at 15%. They have, the total amount they've raised is 2,000. You can think of crores, lakhs, anything, doesn't matter. Just take this figure 2,000. 15% annual cost is 300. This will go as dividend. Loans 12%. they've taken 1,000 as loans, 1,000 rupees. At 12%, the cost is 120. Total is 3,000, 2 plus 1. Total cost 420. Okay. Take capital company B now. Here it's reversed. So the shareholders' equity at 15% is 1,000. The cost for this at 15% is 150. The loans debt at the rate of 12% is 2,000. The cost is therefore 240. Total capital is the same, 3,000. Total cost is 290. 390, sorry. Here it was 420. So basically, what do we observe out here? If you have more of equity, your cost is going to be higher. So we calculated the percentage. How do we do that? You take the full amount and you take the, sorry, this is just a mistake here. You take 420 out of 3,000 and here you take 390 out of 3,000. So it will basically, you'll get 14% and 13%. So essentially what happens is the cost will tend to be higher if you have more equity. The cost will be less when you have debt. So why don't companies take more debt? Why don't they prefer debt? The reason for that is when you take debt, you are committing to repay within a certain time frame. If the market trends don't support you, it is possible that you will not be able to generate the sort of revenue that is required to repay within that time frame, and that could land you in big trouble. The bank would begin to demand its money back. You'd get adverse publicity. The adverse publicity could affect your reputation, which in turn could affect your acceptability in the public and things like that. So it could create big trouble for you. The cost of capital, sometimes also referred to as the weighted average cost of capital. We don't have to get into that part there. Now just let's look at this again. Shareholders equity 2,000 for company A, 2,000, loans 1,000, total 3,000. Profit before interest and tax. That means the company earns this amount of profit, 750 in a year. It does its business. It earns this amount, 750. It pays 120 as interest. See, remember that loans at 12%. 1,000 is the amount of loans, pays this. Profit after interest is 630. Then it pays taxes at 255. 40% comes to 255. It gets profit after tax of 1,375. So what is the return on capital? 375 out of 2,000, 18.75. Sorry, this. Then the other company, B, it has shareholders equity of 1,000, loans of 2,000, total is 3,000. It also makes a profit of 750. Remember, we said these are similar businesses. The interest now is 240 because 2,000 into 12. So the profit after interest is less, 510. But where does it gain? It pays less taxes. So its profit after tax is 306. The return on capital is 30.6. Why? Because here the owners have only invested 1,000, but they've borrowed 2,000. So they're using less of their money, more of borrowed money. So from a point of view of returns on equity, return, like whenever you invest in a bank, they give you something. No? That's your return. So these guys, they invested 1,000. The return they get is 306. That's 30.6. These guys invested 2,000. The return they got 375. But in terms of percentage, what they get? They got 18.5. 0.75. So these are the pluses and minuses of the thing. But from a shareholder equity point of view, from an investor's point of view, if you can use loans effectively, you will end up getting a higher return on your capital. Why? Because you are playing the game with borrowed money. You're not putting in your own money. You're taking somebody's money at 12%. You're earning 15%. You're coolly pocketing 3%. But the amount you're actually investing is less. So when you do this, this is not, when you take loans, the word in finance which you use is, you say you leverage your equity. It's like a lever. You put in 1,000, you are able to lift 2,000 of loans. Because the banker is willing to trust you because you've put in 1,000. So they give you 2. It's a normal sort of thing. This is not something which I'm just putting here as an example, which is unrealistic. This happens quite often, that a company puts in 1 and gets as much as 3 as loans, 3 times of that amount. Total, they get 4. They use 4 to make a lot of money, repay the loans, and the investors get a huge amount of. Just give me a minute. Okay. Then, so more or less, this was about a little about structure, a little about what finance means to a business. After this, let's look a little at at another aspect, the corporate strategy. Now, when we say corporate, we are basically talking about a company. Corporate is basically coming from corporation. Corporation itself is coming from a body which has been incorporated. Incorporated means it has been registered with the registrar of companies. It has become a legal person. See, the big thing about a company is that it works, its legal rights are the same as a individual's. It's a legal person. So it has rights of its own, it's a legal person. So what is strategy actually? So a plan of action designed for a long-term goal. So when we talk about strategy, think of long-term. Is it the same as a plan? No. Plan can be made for a goal we want to achieve immediately. A strategy, by definition, will be for something which is long-term. The plan is going to be more detailed. The strategy is going to be general. Like, for example, strategy. Hyundai is sitting in Korea. The Korean management of Hyundai decides that we can make a lot of money if we manufacture cars in India and then export that to South America. India, we get land, we get labor. It's cheaper out there. We use our own money. The government gives us some sort of incentive to come and invest, make in India. So remember, the government has the Make in India thing going. So they make it easy for a foreign company to come set up its businesses here, invest, everything. So that is a strategy. This is a big thing. The plan is long-term. They will make stuff in India. It will take some time to get that factory together. After that, the factory will begin to produce. Then the finished goods will have to be shipped all the way to South America. They actually do this. This is not hypothetical. They actually do this. Now, the plan to implement this, you have to get into a lot of detail. The detailed plan is needed, which will consider the steps to be taken in India to set up the manufacturing plant. You will require licenses, permissions, pollution control, all sorts of things are going to come. Then you'll need to, recruit people. You will have to have this whole HR thing going. You will have to source your raw materials. You'll have to do a lot of inventory management. Those of you who are supply chain management guys, you will understand this better. You'll have to get into that entire detail. Once you get that, you begin to make your stuff, and then the logistics of actually taking all those cars, transferring them to South America, selling them there, running a marketing campaign there, competing with other companies there, other Korean companies, other Japanese companies, even other American companies. That's an international market. And then coming out on top and making money. So each and every element, the detailed part, that is the plan. The strategy is the big one. What we want to do is, let's set it up in India, let's sell it in South America. So I've got two parts of the end goal is clear. The details we flesh out, we make a plan. What is a corporation? Like I said, it's a company registered with the Registrar of Companies. It is generally run by a board of directors acting on behalf of the owners. Who are the owners? All the shareholders. And most important, it is a distinct legal entity. Other point here is the liability is limited. The liability of each shareholder, including the promoter, is limited to the amount of shares which they have bought. Personal attachment of personal assets will generally never happen unless the guy commits a criminal offense. He tries to defraud his shareholders. Like if you want to take some famous examples, you can take cases like Nirav Modi or Mallya, these guys, Vijay Mallya and things like that. The only reason which they have run into trouble with the ED and things like that are because they have indulged in fraud. So once it becomes a criminal offense, it's a different ball game altogether. But if they continue to play the game, the company game, without actually committing any fraud, their personal assets will never be attached. Only those assets will be attached which are owned by the company. So land that is owned by the company, machines that are owned by the company, buildings that are owned by the company, those can be attached. As a banker, I can tell you this has been one of the biggest problems that we face when it comes to recovering loans. Because you will find at that point of time that there are very few valuable assets which you can actually sell. Okay? So a new company is formed. So normally it will have a vision. There'll be a statement. What is the vision? Like any vision, it is basically about where the company sees itself in the future. The company, thinking ahead, where is it going to be, let's say 20, 30 years from today? It also has a mission. Why was the company created? Vision, one thing. Mission, another. Why was the company created? The vision and mission tell us about what the company wants to do, what its broad goals are. The board of the company takes action to fulfill these goals. So why did I introduce vision and mission? Because the corporate strategy is ultimately about fulfilling these two things. The vision and the mission is going to, these are the boundaries within which you will make your strategy. For example, you take Amazon. If you look at the website, it says our vision is to be the earth's most customer-centric company. To build a place where people can discover anything they might want to buy online. All of you have bought stuff from Amazon. You can see how they have essentially done exactly what they say, Earth's most customer-centric company. Yesterday, I had an experience where I had ordered something. As it was a gift, essentially, for my elder sister. The guy came, delivered it, and then took cash. I had already paid for it. So I took it up with Amazon. It took exactly 1 hour for the guy to come back and give me the cash back. Give my sister the cash back. Customer-centric. Focused on customers. To build a place where people can discover anything they might want to buy online. I'm sure all of you have this experience. You want to buy something, you check out Amazon, you'll find it. What is the mission? To serve customers through online and physical stores and focus on selection, price, and convenience. So, within this vision and this, the strategies are going to be essentially formulated for the achievement of these two things. That's how the corporate objective takes shape. First, look at the vision, look at the mission, then you form your strategy. So that if the strategy is successful, let's say Hyundai, if its idea is to become the world's largest car selling company, then it makes sense for them to set up a factory in India and to basically sell it in South America. So they expand their markets across the world. They expand their manufacturing units across the world. In the process, they produce a large number of cars, and they are more or less in line with their vision of becoming the largest selling car company in the world. It's like that. So whatever strategy the company will have will essentially be based on these two things. So the corporate strategy of the company answers the fundamental question. How do we use the resources of the company to achieve its goals as set out in the vision and mission statements? And how do we use the resources to create a competitive advantage for the company? Whatever you're selling, you're not the only person selling it. You're not the only company selling it. There will always be other people selling something very similar to what you are selling. And how do you have an edge over them? How do you have an edge over them? That edge can be in many places. We'll look at some examples. That edge is the competitive advantage. Now, strategy must consider three factors: resources of the company, capabilities and competencies of the company, opportunities that the company has given its resources and competencies. So resources, okay, what exactly do you have? Your financial resources, physical, the human resources, everything. And once you begin to use these to make products, to sell, you consider the risk that the company faces. Because if you fail, if you use these resources and you fail, you will be putting yourself into a financial ditch, some sort of a hole, because you will not be generating money. Once the strategy has been made, the company can proceed to the planning stage. Like we saw in the case of Hyundai, strategy was to build in India, sell South America. Planning was the next part. Now, for a company to succeed in the market, it should have an advantage over the other players who are its competitors. Competitors try to sell their goods, services to the same customers. Remember, the group, the market which you're targeting is the same for other companies also. If you're selling cars of a particular price band, you will be essentially competing for the business from the same customers. The advantage that a company has depends on its resources, capabilities, and competencies. What are the resources? These are the assets: physical, intellectual, human, financial. So when I say intellectual, please don't confuse it with human. Human resources are the staff, the employees of the company. The intellectual resources are the patents, the intellectual property that the company has, the designs that it has patented, the machines that it has which are its own. For example, I remember Tata coming out with something called a Revotron engine. That's a patented thing. They made it. It's theirs. So that's like intellectual resource. or let's say the designing and manufacturing capabilities of Apple. That is an intellectual thing. The guys who actually do it, those are the human part. Financial is clear. Physical is anything with a physical shape. Capabilities are the ability to exploit these assets. These are the assets. But can you exploit them? Can you actually use them? The resources have to be used in a way that best serves the company's goals. This depends on the way these resources are deployed. And who does this? A good leadership. They are the guys who do this. The physical resources like machines should be used to make the best product. Financial resources should be used judiciously. Don't use too much. Don't underfinance. Don't use too little. IP should be safeguarded and used for the benefit of the company. Human resources should be deployed so as to get the best out of the personnel. These are, like general statements, but you get the idea now. Capabilities will depend on this. Can you use your resources in a way which will achieve the objective of the company and generate profits? Build a good reputation, ensure that you have a good future. Competencies are a cross-functional integration and coordination of capabilities. So if you want to understand the difference between these two, this cross-functional integration, think of it like this. Just let's take 4 major parts of the functional areas of a business. There's the operations, manufacturing, marketing and sales, quality control, finance. There can be others. Let's take these 4 dimensions. So when these different departments work together as a team with a common goal, the company is considered to have the competency to succeed. But many, many companies don't actually manage to work in sync with each other. When they don't do that, it will result in suboptimal performance. They aren't going to do so well. So if the company is able to do better than its competitors, it is said to have a competitive advantage. So if the company can actually, get these guys to work as a team, it has the physical resources, the intellectual property, all that. If all that is there, the finance is available, those can be used properly, then that company will definitely end up with some sort of a competitive advantage. Take Apple, for example. Let's take the same parameters. So operations, manufacturing. What are the advantages which it has? In operations, innovative products. If any of you use Apple products, I think it'll be easy to understand this. Innovative products, excellently designed, that customers desire and are willing to pay extra for. If you buy an Apple phone, an iPhone, you will definitely be paying a little more than the equivalent Android. Company owns, look at this other advantage that it has. It owns chip manufacturers, controls manufacturing, follows extremely strict software standards, and operates its own stores. Okay. So this is again an advantage. It owns the chip manufacturers. It controls the manufacturing. It doesn't matter that it's being made in Taiwan. They are controlling it. They prefer to have it done there because there is a cost advantage. And they get the skilled labor which they require, which maybe is not available in US. It also has a community of more than 6 million independent software developers creating apps for Apple products. Ultimately, it's all about apps. No? I mean, I'm older guys, but you guys know it much better than me. Ultimately, it has to be about apps. Even I'm beginning to understand that. So, a phone which sort of supports a certain amount of apps, and if those apps make sense for me, I buy the phone. So, other aspect, it's a debt-free company. Finance. This again is a competitive advantage. Because that means you never have to borrow. You have your own funds. You're making so much money. Like we saw in the case of HCL, 271 crores, 30,168 crores in 2019 as profit, which has increased to 43,000 again by the time we come to 21. Take Maruti now. Same four parameters. Huh? What does Maruti have? Quality of cars in terms of design, fuel efficiency, durability, etc., and price. Out of 15 top models in terms of sales, Maruti had 10 models, numbers 1 to 10 in 2019. I'm giving 2019 because this is one of their best years. Good technology because of the Suzuki connection. Marketing and sales, wide network of dealers, excellent service network backed by very low maintenance costs. If any of you have a Maruti, you will know that this is absolutely true. Compared with any other company, the cost of its components, the service charges which they take are very, very low. Repairs and maintenance, very easy throughout the country. That throughout the country is literal. You can get stranded on a highway, you'll still find a Maruti service station within 50 kilometers of you. There'll be somebody or other out there. And it is a debt-free company in an industry which is capital intensive. See, for a soft company to be debt-free is not a big deal. But for a company which has a huge amount to invest in machines, in the infrastructure, it's a real big thing to be debt-free. So these are just examples of competitive advantage. So now if a competitor comes, see, think of it like this. Suppose somebody wants to come now, build cars. Look at the problem which they are going to face. If they can build up something as good as this, only then will they be able to compete. Otherwise, on one point or the other, they are going to fail. So you want to buy, let's say, make mobile phones. Can you actually make something as good as Apple? Do you have the designing capabilities? If you do have the designing capabilities, can you actually get those 6 million independent software developers to make apps for you? Can you actually do it only with your own funds? So each of these, if you can't do it, it means you are at a disadvantage compared to Apple. A guy wanting to get into the car making business, if he can't replicate this disadvantage as compared with Maruti, they may make sales, it doesn't matter. But will they ever make enough to, have a sustainable business? Very doubtful. So these are things which are important. Components of strategy. Do you want me to continue or for another 5-10 minutes, or should we end it here? Since this is supposed to be till 8.
No, please continue.
You'll have to raise your hand. Do you want me to continue? Okay. Okay, fine. Thank you. Thank you. Chalo. Then let's continue with this. Now, components of strategy. One is called product market scope. What is the market scope of your product? Whatever you're making. And when I say product, remember, it doesn't have to be a physical product. It can be any form of service that you're giving. Which products will the company manufacture or provide service, and in which market will it sell these products? The market segment in terms of age, income, other characteristics should be defined precisely. So I'm talking about you're making a strategy, you have a product, you've already identified your market. The point is, you better get this correct. Sell the right product in the right market. You have a good product, you're selling it in the wrong market. You won't make any sales. The existing players who the company will compete with and the products that they offer will have to be considered. So when you choose a market and you have a product, you also know that there is some other company which has a similar product and which is competing for business from the same bunch of customers. So can you compete with them? Is your product as good as theirs? Get that product, have a look, compare it with yours. Look at the pricing which they have. Can you come at that price? Can you beat them at their price? Can you beat them in quality? Where exactly are you going to fit in here? What is your competitive advantage? Is it coming from technology, design? Is it your human resources? Is it your marketing and selling capabilities, excellent dealer networks? This last part, marketing, selling capabilities, never feel that this is a minor thing. I can give you one example, Asian Paints. Asian Paints has got its selling and marketing strategy down to a T. It is so good. It is so good that it sells more paint than others, mainly based on this element. Their capability is here. They don't make the best paint. No. If you go and ask your painter, I want to do my house and should I use Asian Paints, he'll probably say no. But you go and ask a dealer, which do you want to sell? He'll probably say, I want to sell Asian Paints. Why? Because those guys are really looking after their dealers. How do they look after them? They say you don't have to spend too much money on maintaining a huge inventory. You keep a small inventory, we will keep supplying you as soon as you sell. So the amount of capital the dealer blocks in buying inventory is less. Now that becomes a huge thing for the dealer. Okay, I can actually sell this big brand of paint without actually spending too much money. If I go for some other Dulux or something, then I have to get more capital. Ultimately, it is about money. Nobody has extra money. And if I can do the same thing with less money, why not? The margins are more or less the same for everyone. Plus, the marketing is so good that there is a huge public awareness about the product. It's a visible product. So a dealer feels comfortable in stocking up with that and selling it. Distinctive competencies. So all good companies have some core competency, something which they do better than the other companies. This distinctive competency is actually a part of this competitive advantage thing. This concept of a core competency, something special. In the case of Asian Paints, that something special is marketing and selling, which in turn is based on a terrific data warehouse. They invested in computers and networking their dealers and all for 20 years ago, when other companies were not thinking ahead like that. They put in a good amount of money in putting in place the hardware and the networks and everything. Today, they are reaping the harvest. They're getting a big advantage. Synergy. This is the one where the company, core competency of the company and the product market scope, these two have to be in sync. So whatever is the product and your core competency, if these two things match the market, then you're playing the game the right way, you will make money. This is a more detailed example of the same thing, where I talk about, product market scope can be developed as follows. So let's say that product and RD team, they develop a detergent. It is manufactured. You begin to market, you build up what is known as a value proposition. Basically, what value does the customer get if he buys your product? And then it sells. You have to have a selling strategy. Now, every time you sell, you also generate some feedback from the customer. And that feedback, let's say something to do with your product or something to do with some other part of your entire company, you sort of send this back to your product and RD team so that they can continue to improve. So most products in the market now that you see, you'll keep seeing better and better versions of that product as the time goes by. How does that happen? It's based on this feedback loop. And there has to be a synergy between all these different parts. where they all work together. And that creates that particular competitive advantage, and it works. In this case, I said what would be, one example could be, what is the competitive advantage this particular company has? It is the eco-friendly nature of the washing powder without any loss of cleaning capacity. The price is also reasonable. So they managed to maintain a reasonable price. It is eco-friendly. And the powder itself, the cleaning capacity is as good as the other powder, which is not as eco-friendly. So today, where we think in terms of a green world, we understand what climate change is about, we understand all these things, there is an inclination to go for products which are considered to be eco-friendly. And who will buy these products? The market side. So there are individuals and there are industrial laundries. So this is an example of the product market scope that the company has. Now, company has the resources and the capability to produce the washing powder. It now has to put in place a marketing campaign that makes the target segment aware of the new washing powder. Its competency will lie in ensuring that the operations, marketing team, and sales workforce work in tandem to build up the sales of the product. So you have your market, you have your product, you have your competitive advantage, but somebody has to get this message to the public. So unless the public are made aware of this, your competitive advantage itself will have no meaning. People have to understand and they have to believe what you're saying. If they don't believe it, if they feel it's just a marketing gimmick, even then it's not going to work. So somewhere down the line, all these things have to fall into place before you can actually do something positive. So what we'll do is, we will end this here and we will continue with this tomorrow. I just hope tomorrow I have a better internet connection. I'm just so happy that you people have been able to hear me clearly. Though I haven't been able to hear you, which is a big loss, because this could have been more fun had it been interactive. But in case, I hope you've been satisfied. So if you can just say, like put a hand up or something, just to tell me that you've understood the sort of presentation I've made, that will give me some satisfaction. Are you okay with today's class? Okay. Thank you. Thank you so much. So I think we can end it today. It's 10 past 8. I think we made up some of the time we lost because of all those disruptions we had in the beginning. And then see you tomorrow at 6 o'clock.